And this is a question I get more than any other. Where do you start your volume profile on the 1 minute time frame? Most people anchor it to a session, midnight to midnight, or a fixed number of hours, and then they wonder why those levels don't work. I don't anchor it to the clock, I anchor it to the balance when it comes to the 1 minute time frame. Look at this chart with nothing on it. Your job isn't to find a direction yet. Your job is to find where price stops from going anywhere. Here is the same chart with the profile on it. I started it here at 620, where price came out of that sharp move and immediately began rotating, and it ended here around 7, where price left the area and stopped coming back. That's the whole rule. Start where the rotation begins, end where the rotation ends. Not where the session opened, not where a clock said to. The market doesn't care what time your broker thinks it is. It cares where there's two-sided business actually happening, buyers and sellers interacting. If price is still rotating inside that area, back and forth, back and forth, back and forth, the profile isn't finished. If price has left and isn't returning, the profile is done. It is now a reference. Once the balance is defined, I only care about 3 lines. The top of value at roughly 41.48 right here, the bottom of the value that is roughly at 41.36, and the point of control in the middle, which is around 41.45. 23,000 lots were traded inside of this shape with a delta of positive 827. Okay, and here's the part that people skip. The top and the bottom are where I trade. The middle is not where I trade. The control point, the point of control, is where buyers and sellers agree the most. Agreement means contested. Contested means chop. I use it as a target, never as an entry. Now watch what happens above the value area, at the value area high. This box roughly around 41.50 to 41.52. Price had been there already once and it failed. It came back a second time right here, and this is where it matters. Buyers kept lifting the offer up here. Price stopped moving up, and that absorption turned into exhaustion. Aggressive buying meeting size that wasn't moving and then running out, so it came back down. It was previously tested right here. It held again. The buyers were exhausted at the top of a defined balance. That's a location. If you're short from that edge, your targets are already drawn for you. The point of control at 41.45, then the bottom of the value area low at 41.36, and price walked all the way down through both of those. You don't need a signal, you just need a boundary and a reason. Okay, now same market later in the day. Try it yourself before I draw anything. Where does price stop trending and start rotating? Here, a small one, only 2,000 lots, but it's a proper shape. Price rotated across it several times, respected both edges. Once, it broke out of the top value and it kept going. Small balances still count. What matters isn't the size of the profile, it's whether the market actually did two-sided business inside of it. The buyers and the sellers interaction. Now, here's the one people get trapped by. This looks like a balance. It has a shape, it has a value area, it has a control point. But look closer, 3,000 lots, delta of positive 84, and the entire value area is barely 2 points wide, sitting directly inside a strong bearish leg. That's not balance. I would say that's a pause. Sellers didn't stop. They just took a breath, and then price breaks the bottom of the value area. Then it came back to retest right here, and this retest is the whole trade, not the break. The retest. If price re-entered the value area and started rotating again, the break failed and you stand down. It never did. It touched the underside, couldn't get back in, and that rejection was the confirmation for the continuation trend. No acceptance back into balance means the market has left a balance. Therefore, it is in balance. And when the market leaves balance, it becomes imbalanced, okay? And imbalance is where you ride the trend. You do not fade it. From 41, 42 down all the way to 41, 33 with almost no rotation. That's easily a 100 pip trade right there. Last one, and this is the cleanest version of this whole idea. Price is chopping. 7,000 lots builds a proper D shape. When I say chopping, it's ranging, okay? It breaks above the top value, the value area high, immediately comes back in. That's the failed continuation. It re-entered the value area and it rotated. It went all the way down, touched the control point. Then right here we see that it probed below the value area low. Big trades indicator, sellers failed, came back to retest at this level, and we see that it got no acceptance. It rejected from below back inside. Then we see again both edges were tested and both edges were rejected. It came back, touched the point of control in this area right here as we see, and then it left balance fully mapped. It left the value area high and it just took off. This time it never came back. 41.41 to 41.61, 200 pips, all in one direction, almost no rotation, okay? It just took off. That's the sequence. Balance builds, the edges get tested, and one of them finally fails to hold price inside. That's the moment price refuses to re-enter. You're no longer trading a range, you're riding the imbalance, and that can go in either direction. There's 4 things to take from this. 1. Anchor the profile to the balance, not to the clock, on the 1 minute time frame. 2. Mark the top, the bottom, and the point of control. And when I say the top or the bottom, I mean the value area high and the value area low. Trade the top and bottom, top edge and bottom edge, okay? 3. Check whether the balance is real. Volume, delta, rotations, volume profile shapes, that is what tells you. 4. Retest after the break matters more than the break itself. The market shows you where it agreed and where it didn't. Your only job is to market honestly. Remember, candlesticks were the shadow and order flow was the light.